Hi, everybody. Welcome to our weekly market recap. This week gave us one of the cleanest macro tells we've seen in years. Risk assets are not moving together anymore, and we are in a rotation regime, and crypto is not the leader, unfortunately. So, gold and silver, we see new highs now correcting strongly, but definitely energy commodities are accelerating. We see equities rotating internally, and as I mentioned, crypto unfortunately underperforming. And I think that divergence matters more than any single price target. So let's walk through the macro first, as always, and then bring it back to Bitcoin and crypto positioning. So when we look at our cross-asset dashboard, you see the loser for the last 7 days is unfortunately crypto, Bitcoin minus 6%, 0.50 minus 5. We have relative outperformance of digital assets equities due to the AI theme and the miners. But you see overall for risk assets, it was positive. You see S&P slightly up with the comeback of tech, but the overall theme that international assets are outperforming is still valid for the year, especially with emerging markets. But the overall focus, of course, was on gold and silver, which had a brutal performance. And so before we go to the commodities, I want to highlight that an interesting statistics that depending on how the January goes for American stocks, that's based on the S&P 500 here, that's a predictor for the next 11 months. So you see whenever the S&P finished in green for the January, it was up around 12% for the year. If it's down, however, it's more or less neutral. So I'm recording this around noon Central European time. We have still the whole day, and the US futures are negative. So let's see how we're just up slightly for the year. So let's see how the day goes on. But definitely interesting statistic here. Now, commodities, I think we are in a commodity bull. You see here the energy sector against TLT, against 20 plus years US treasuries. You see the ratios going up, meaning energy is outperforming regardless of the long end going higher and what the Fed is doing. That's pretty strong. And you also see that why the blue line commodities had a great run. Energy is still lacking, and I think that's the last man standing and will catch up pretty strongly. Now, in focus was, of course, silver this year and the last 7 days. You see we are now correcting minus 10, minus 11%. And that's a log chart after having this parabola. I wouldn't be surprised if we go down to the $70 level, and you see silver very often has strong pullbacks, strong corrections. Normally these parabolas are then the top. Let's see, but the $70 level would be a logical level for me for a pullback. Also gold is correcting now, but that's having a support from central banks and is less retail driven than silver. Now also in focus, of course, was the dollar. We had very weak 2 week red candles, and let's see if we can recover, or if also that's the signal for this year, a further weakening dollar, which of course would support this commodity rally, would generally be supportive for risk assets. Let's see, but everybody is watching that. Huge volatility there, which doesn't speak for for the belief in the US government. And unfortunately, also, if you look at the Bitcoin chart, we are right at the neckline here of this head and shoulder. And I showed it in one of the last videos. I just put the fractal here to the chart. And I think that's the blueprint, because I think we are in a classic 4-year cycle. I know a lot of people say the 4-year cycle is dead, but I mean, it looks like it's not dead. Yeah. So we had the high in October, and now we are just following a down year, which we always have every 4 years. And a normal pause would be then end of Q2, beginning of Q3. Now, I don't think we get this spike here, which was the FTX low, but I think a logical region to stop would be the 60 to 70K level, which would be the last high of the last cycle. That would be nice if we stop here. So it's more, for me, an accumulation year. And also in focus, of course, is the Bitcoin gold chart. And we stopped here right at the support. We sliced a little bit through it. I hope we can defend this level here. Otherwise, I think the 12 region of this ratio is very likely. And people are now saying that Bitcoin is not a gold's replacement, or is not digital gold. And I would say, while it's for sure disappointing, I want to highlight that it's a very good complement to gold, because we have created the Coinbase Store of Value Index, which is including Bitcoin and gold. Why? Because gold is longer term. I just make the graph larger. Uncorrelated. You see it here, the green line. Sometimes it's negative, sometimes it's positive, but overall it's uncorrelated. And that's very beneficial then to have in a portfolio. You want that. If you have several assets, you want uncorrelated assets. And both assets share the same attributes, right? With and especially gold has benefits when it comes to portability. You can verify it better. Transport is better. And so in a digital world, it just makes sense to have that as a digital gold. And I still stick to that. You see the performance of this combination is pretty strong. It's a beautiful chart. It outperforms gold. It has a higher sharp. It has a higher sharp ratio here. Yeah, with 1.29 versus 0.85, and almost the same drawdown. So yes, there is weakness in Bitcoin, and while I don't like it, it's part of the game when you want to be an uncorrelated asset. Now, people should, in this year of a bear market, they should focus on what is maybe working. And if you look at the top 10 over the last 7 days, you see, for example, Hyperliquid is doing very well with plus 44%. Now, how on earth is that possible? If you look at Hyperliquid, it's a decentralized exchange doing perpetual swaps, so derivatives on chain. And the interesting thing is, if you look at the largest trading pairs, it's Bitcoin, ETH, of course, but you see silver already. You see gold, you see copper, you see here, that's I think a top 100 equity index. You see the crypto degens are now also trading TradFi on chain, and I think that's the future. And Hyperliquid is doing a ton of revenue with just a handful of employees. I think it's, if I'm not mistaken, $75 million per employee. So you see here the token terminal on-chain data. They did in the last quarter $250 million in fees or revenue here. It was $320 million the prior quarter. So they earn a shit ton of money, and they are buying back tokens worth 90% of the revenue. Yeah, so that's a huge support for the token, for the hyperliquid token. And you also see that in the performance. Yeah, you see here a nice few green candles. It's up over the year. Yeah, it's one of the few outliers. And I think in a bear market, people should focus on what has relative strength. And that could be the future winners for the next cycle. Now, we systemized that with our market vector token terminal fundamental index, where we look at fees and revenue, and hyperliquid is the second largest token after Tron, which also has nice fundamentals. It's doing a ton of tether transactions. Also BNB is burning a lot of their token. They have a lot of transactions and fee generation. And I think that's maybe a theme for this year, that people look a little bit deeper, look at the tokenomics, look at the traction of the protocol. And I think there is value in analyzing that. I think that's my main message for this week. So the big takeaway is this. This is not a crypto is dead moment. It's a wait for the right pitch moment. And macro is telling you where capital is flowing. Right now it's not flowing into speculative liquidity assets. But if people focus on relative strength in a weaker crypto market, they find the right things for the next cycle. So if you found this breakdown useful, hit like, subscribe, and let me know in the comments what you're watching next, because as you know, the next real opportunity usually comes after the hardest patience test. So see you in the next one.